This is Justin Pulitzer. This is my weekend review video for Monday, February 20th, 2017. Happy President's Day. Good amount of stuff to cover. Going to start out with the economic backdrop, go into the 7 market keys along with some stocks that may be of some relevance to them, the major market indices, and then I'll talk about some of the momentum stocks, and if I have time, we'll get into some of the requests. So, the economic backdrop. Couple of things to talk about. First and foremost is we've now had 2 back-to-back barn burners out of the Philly Fed. They were supposed to have a 19.3 consensus number, and this was at 43.3. This is, as the survey mentions, the highest since January of 1984. So that's also on the back of a pretty big beat in the last go-round. So the economy is picking up. That is basically what I'm saying. The prospects, we all know what the Trump rally has been about: deregulation, the repeal, the Dodd-Frank and all that stuff for the financials, repatriation, and tax cuts, and basically a more business-friendly environment. So that is, I think, getting some animal spirits going. The interesting part, though, is you had some talk out of the Fed this week. The Fed heads love to hear themselves speak. I guess that ivory tower, when they're out and they're around people, they like to talk. So Yellen spoke. I didn't really hear much out of her that was different than the last few times that she spoke, and the other Fed chowderheads are talking, yapping it up. Anyhow, the probability of a Fed rate hike in March is pretty low. It had a bit of a bump, but it has come back down a little. I think that's because there's some uncertainty about the tax cuts and the regulations and when this stuff may go through, and of course the repeal and potentially replace of Obamacare. I was going to say the disaster known as Obamacare, but I'm trying to be a little more PC, but it has been a bit of a problem. Obviously, everybody knows the premiums and the deductibles have all gone up really big, and it's been an onerous tax on business, and I think that's been a big portion of the reason why companies have been part-timing rather than full-time hiring. May, rather low. The rate hike probably still low, but increasing. June, getting a little higher, still below that 50% threshold. July, low. September, also low. November, low. December, low. It seems as if the market isn't factoring in much of anything in terms of the Fed. Is that a mistake? I can't tell you. But what I can tell you is this, is I did a survey that had a hell of a higher percentage, and I think that this is going to be sort of the I have a test tomorrow scenario, and you didn't study, you've been out all weekend and you forgot that you have a test the next day, and then there's sort of a last minute freak out. We've seen that happen with the Fed a few times, and that could be the case again. We'll have to see how that does play out, but as of now, the market thinks that the Fed is bluffing. They don't see much in the way of interest rate hikes. I've put on a long chart here. 4 years worth of volatility. We're pretty low. I don't really see much of anything until we can start taking out the 200 MA. After that, I think we could maybe resume a uptick in volatility, which could be nice. Anyway, the Friday close was below this key level, and it is we had this bit of an up move as the market went up, and I think this was a combination of option rollover, expiration, obviously, some hedging, and maybe just some cheap bets on the short side at the all-time highs, and some hedging. You could also, there were some reports that there was some fund that had some strategy problems. They had basically been selling calls, and I think that they got a bit of a squeeze situation, and they were forced to buy back. And if there's, believe it or not, enough call buying, it could cause a spike in the volatility. It's usually only associated with puts, but that really isn't the case. Anyway, we are, this was the Fed day. We had that look below 10. I have warned that I did think we'd see that, and that could be the bottom in volatility. We're going to have to see how that plays out, but I don't necessarily know that it's just going to be off to the races. But I am cautious here. I have been detailing some put ratios. I'm sorry, I guess you could say put ratios. Calendar plays. I basically have been calling them put spread overwrites. So, for example, I would buy, let's say, 234 puts. I would sell 230 or 229 puts, and then overwrite, and let's say that's out like 90 days or whatever. Then like maybe 50 days out, I would overwrite in a more near dated strike and maybe sell the 211s or the 215s or something along those lines. And I've said that these were hedges against long positions and, just outright cheap short bets that haven't really been costing me very much. The overwrite obviously facilitates that. The danger you have is if the overwrite, if the market comes down too far, too fast, and you get nailed on the delta, really delta gamma. Don't want to get too much into that, but if you don't know what I'm talking about, put this on hold and look up the Black-Scholes option pricing model, and you'll know what I'm talking about quickly. And, of course, Vega risk, which is the IV. If this were to spike pretty high and you had the price coming down, that would put a hurt on the overwrite short position. That's why I've done them more near dated in case I need to roll them out, down or out, or increase size at some point. And more near dated, you could kind of have some predictions. It seems unlikely to me that the market coming from all-time highs is just going to fall straight through to Hades without having bounces at major moving averages and at breakout points and so on and so forth. And I've said for a while that I, think that a 50-day MA touch is possibly in the cards in the, the medium-dated future. We'll see. I don't want to get into my SPY analysis too much now, but basically that's what I've been thinking here with regard to the VIX. So until we start getting above the 200 MA, I don't know that there's that much to see. It's very easy to get tapped. It's possible we come higher, and bounce around, but we've seen periods of time here where this, goes on for a long time, this contraction of volatility. I mean, it usually leads to an expansion, but it can take its time. The bonds. So, let's zoom in here. We are above the Fed day high. That was this day. We've had a couple of looks into it, and we have a bit of a channel. It seems to me that the 50 MA now is sort of the key, somewhere between 119.21 and where is this 50 exactly? And I'm just zooming in, 119.65. So I'm willing to stipulate that as long as we hold this this area, you have a swing low here at 118.65. So if you want, you can put this trade on long and stop below this low. If that were to break, I think we'd see this new low. I mean, a revisit of the the recent low and maybe even beyond. But it seems to me as long as we're above the 119.21, there could be a bounce in the TLT. That also reflects the low probability of the Fed hiking rates, right? HYG, so this has been, I had talked about this as a short, a cover, a reshort, and now it's been bullish, right? You had a bit of a topping tail here on Thursday, but Friday kind of held. It's been in this consolidation for a while with the 20 MA basically being the hold point, so I think it's going to be okay as long as the 20 MA holds and you have 50 MA kind of close behind and 100. I mean, these are all bending up. That's a healthy pattern. When you start having major market indice average, or not even the indices, but like important indicators like this bending, it starts becoming a bit of a problem. So we have broken some trends that I've drawn in, and you can see I'm deleting them. More, though, by time than by price. And I think if you want, I mean, you were basically in a range. This was a bit of a look below range that failed, and now this is a bit of a look above range that failed. So if you're itching to try the short, I mean, I guess you could do it with a stop above this 88.08. I really don't think that. I don't know how profitable this will be, though. I mean, I basically would be playing for a move down to the lower end of the range. I guess you could take a buck out of it. Here, I was looking for more of that cascading play. So I do think that the credit situation is improving, and this pattern to me is starting to look kind of more bullish. So I'd probably be looking more to buy those dips down to moving averages than I am looking to short here. But short term, it may be in for a little bit of a pullback. Oil is acting, I think for a lot of people it's confounding, because you've had these huge increases in rig counts and you've had these big increases in inventories, and yet oil is basically threatening to still to break out, right? You've had a couple of look aboves here that have pulled back even more. I mean, look at these. These have all been like little look aboves and fails. You've had a couple of look below and fails, and it's just consolidating and chopping. So I'm going to say that I'm assuming we're in a range here until the range breaks out. And I'm going to start maybe expanding that range. I'd originally said 52s, but now I think it could be even into 51s because of these highs, these kind of highs, and then these reference lows. But if this does take this out, I know that a lot of people, I've done some polling on this, and everyone's pretty bearish on, amazingly bearish on oil. And it's not a surprise considering how bearishly some of the stocks have been acting, like Exxon, for example. But we do have a bit of a trend break here. I think the more relevance is the sideways, the lateral consolidation than the trend, but it kind of is what it is. This was a look below and fail, clearly, and we came back up. When you have look below ranges that fail, you tend to come to the top of the range, and then we see. There was a lot of talk a couple of weeks ago about this being a head and shoulders. I think I explained that, but let me do it again. This is what you need for head and shoulders. You actually need to spend some time and build it out, not these little pinprick moves. So we're gonna see what goes on with oil pretty soon. The 50 MA has been key, so as long as the 50 MA holds, I think it's gonna be kind of up. If we lose the 50 and the 10, look at this, you have the 10 and the 20 all moving average confluence. So if you start losing that, then maybe there's a move down to the lower end of the range to the 100. But it seems like oil is just consolidating. The curious case of ExxonMobil here. This has been really pretty weak. We are into the area, though, that I said that I wanted to start selling out of the money puts, and I have begun the process. I'm starting to think that we may need another little flusheroo. We'll see. We're basically right near the 50% fib. I drew in a channel low. We'll see how that squares with things. You have a bit of a I don't know, a double bottom, a higher low here potentially. You can see here you've had that kind of a move before upper moves. Here again, that kind of a thing. This here again. This stock doesn't tend to trade like a huge momentum stock, so it sometimes takes some time. This is a pretty big move down. Remember, this was the gap up with the Tillerson. So once you have a look above range that fails, you tend to migrate to the lower end of the range, and that's really where we are. I do think that if there is a flush down to this level, the 77, 78, that will be a great opportunity to sell even more out of the money premium. Remember, I said that this was part of my game plan. I started out small, and I'm looking to expand as we come into some more key reference levels because it's really a kind of a bottom fish here. We'll see what dreams might come here. Anything above 83.42 here, that's this last kind of swing high, I would be into maybe adding to the position. That's also roughly the 20 MA. Look where this broke down from. So if we start getting either lower into the 61.8, I'd be interested in selling out more out of the money puts, or if we get back up above the 20, I might take it on some Momo either in shares or with selling puts. But there is, I know, a lot of put OI and a lot of money flowing into puts. So I'm not discounting fully the fact that there could be some type of a flush before higher. It's odd, though, that Exxon is performing so badly given how well oil is holding in. Exxon tends to be the leader there. So it's confounded me a little bit and has me thinking maybe Exxon is the leading indicator, and maybe oil is getting ready for a move lower. But we'll see. If oil breaks out and Exxon doesn't, then I may have to revisit that correlation. But as of now, I'm still a little on the if side. With regard to China, and this is kind of broken out here. This looks like starting to look a little like a kind of a cup and handle, or even maybe a kind of mini inverse head and shoulders. We're getting close to some reference levels, so there probably will be some profit taking. Remember, I did discuss I thought we'd see the backside of the old uptrend line, and that does seem to be playing out. I like that the 200 is bending up, the 50 is bending up, and the 100 is sort of flattening out and looking to kind of bend up. I like buying into those moving averages on pullbacks. That would preferably be somewhere like near some other reference levels, like these lows maybe, or these highs even better. So I'm thinking China seems to be turning the page a little bit, but I am a little bit mindful and cautious that we are coming into this area, and I prefer buying dips rather than chasing. So where does that leave us with these Chinese stocks that we all have come to either know and love, or love and loathe, or loathe and know? Anyway, this is a gap. This was a break of a trend, and it's done very little. It's just been chopping in a range. So I guess you just say if it's above 99.94, it's still, I guess, a long. Or below there could be a short for a gap fill. Maybe do the 97s to the 100 MA. Look where this was, all this resistance. A retest of the 100 MA to me would be an interesting right or right out buy, including the gap fill. If you do break up above this range, though, the 104.57, I do think we'll see the 109, 110 level rather quickly. One of the requests that came in this week, I don't discuss BIDU that often, although I do have a, I shouldn't say so storied these days because I haven't really traded it a lot in a while, but I used to trade this stock a lot back in the day. So I drew in a consolidation wedge triangle, and they have earnings coming up on 2-23 after the market close. So the expected move is about $8.14 on the snap. When I say on the snap, that's usually right away. Into that expiration is $9.50. So what am I thinking? I'm thinking that the break of the triangle, either up or down, could be a go with. More so, I would think, on the maybe on the upside, because you'd be baked. I mean, if you could get like above the last swing high and the channel, like on some kind of a gap, that to me would be like a professional gap, a trend changer. The ideal scenario here, of course, would be to pull back ahead of the number and then have the gap and go on that. So I think that a break of the triangle, either up or down, is likely a right or right out go with. So I'm going to keep it simple. I don't want to guess really ahead of this, but I would be more into playing, like if this were to pull back like somewhere into either the mid-range or even the lower end of the range, then I might be more willing to speculate on it. But I really want to kind of be the second mouse. It's funny, I just saw Catch Me If You Can, the two mice fall into the bucket of cream. So, and here I am talking about mice, but I'd rather be the second mouse and either play it on the momentum higher, on the trend break, or on the trend snap here. I do think that the triangles will be filled to reference highs or to maybe reference lows. So that's my my take on the BIDU. IBB is starting to perk up a bit. We do have a triangle. So this was also a triangle snap that I said was a go with, and it is. It's going with. You've had some false starts below. Now a move up. You're filled up the triangle here. So what does that mean? This is a potential, I wouldn't say secure high, but it is possible there's a pullback. I like this day's range as the key. So below 290 could be a right or right out short or a stop, and above 296.93 I think would continue up to 301 and maybe even 308, 309. You can see we're kind of ping-ponging in a channel, but we've been mid-channel for a while, and we didn't break down to retest the lows, so maybe this wants to come up to retest the highs. I played this with Gilead. So this is obviously a very nasty head and shoulders topping pattern. This is getting very close to some reference lows. I took the opportunity on this day to buy it via call spreads. I think it was a risk reversal call spread, meaning I sold, I believe, 60 puts and I bought some calls. I forget what it is. I think it was, I forget the exact number, but I basically was playing for the gap fill. I took half off here. I left the short puts on, but I booked half the calls because look, we got basically back to the reference breakdown, and I don't know. I just had the feeling that it would be a good spot to do it. It tends to be how I trade. And here we had a bit of a look and pull back. So I think I would use below 96.26 maybe as a stop on the balance, or maybe even the 10-day, because look, that's really where this broke down from. So somewhere between there, either this one or this low, 96.26, or the 10-day on the balance, I'd stop out, or be looking to close it closer to the 50 MA and the full gap fill, which I do think is probably still in play. It might just chop a little, like you can see. You've had a couple of down days, I guess. Things don't necessarily move all in the right way right away, but it seems like the gap fill is in play in Gilead to me. Let's go to some commodities quickly. Silver. I've been a silver bull for a while. We're getting close to the downtrend, and it's holding above the 200 MA. So at this point, I need to see, for me to continue to add, either a retest of the trend line, preferably a moving average test. Like you can see the 100 MA is where it broke down from, and this is now, it gapped over and came the support. I'd be interested in buying it on a pullback to the 100 MA or on a momentum play for higher on a breakout. But you can see we're into a 50% fib, a downtrend, and I'm fine with booking some profits here. I think that actually is a prudent choice. The 61.8 has been, this is really where the major breakdown took place from, and it had already corrected to there. So, yeah, I mean, longer term, I think silver can go significantly higher, but shorter term, it's into a little bit of some resistance. Gold, also kind of the case. Not as strong as silver, oddly enough, although we are close to the 50% fib, but much further from the downtrend line. So if gold does take off here, usually I say silver leads, but in this instance, gold might be the leader. It's sort of weird. It's gold leads early, and then silver kind of gets the momentum. So above these highs here, I'd be interested in buying gold for a move up to the 61.8. Gold loves 61.8s, by the way. And you'd have a 200 MA, so there, and a downtrend touch, so that area would make some sense to me. Below here, you really need these reference lows to hold 16.15. If that fails, and you have a snap, then I think you'd get a 50 MA touch, probably rather quickly. So keep that in mind. The moving averages there will matter. MAs do matter. SPY. So let's get into some of the neuroses that make me who I am. I created this key here of the Fed Day ranges and VWAPs. I didn't do the VWAP for SPY. I don't know why I didn't write those down, but I didn't. But I did come up with a new novel idea. So you can see for the 214 Fed day range, these are rather close, these Fed day ranges. The highs here and then the lows. So what I did was, I always say above a Fed day high is a long or below a Fed day low is a short, and then I talk about the VWAP in between. So what I did was I took these two Fed day ranges and I blended them into an amalgam here. Now, I took the higher end of the Fed day high and I took the lower end of the Fed day low and I blended that into this. And then I came up with the true VWAP of the day. So how did I do that since this day didn't exist? Well, if you're a slacker, you would just take the 2-day VWAPs, add them up and divide by 2, and you'd come up to 2267.38. But I have 2265.83. I'm sorry, 87. So where did this number come from? Well, I took the total day volumes and I percentage weighted the VWAP by that volume to create this. So this is a volume adjusted VWAP, a blended volume adjusted VWAP. Yeah, so that's the that number, how that came up. So that's sort of the range I'm looking for. To be, above, in between obviously gets more iffy, and then below is a problem. Notice that low 225s, that's really sort of the maximum correction that I think the market can have before being in real trouble. That 225 is a really key strike, and I could easily see there being a pullback to it, but if it's lost, it becomes a bit of a problem. And keep an eye on these highs, these 228s. I want to show you something very key. By the way, if you want it, you could obviously pause the video here and copy this down. You could do a screenshot. You could do whatever. If you're interested in my, you know what? Let me show you. If you're interested in my spreadsheet, how I got to that blended volume, here's the formula. You can just pause your video here, copy it down, and that's how I did it. So that's that. Anyway, let's get into the SPY analysis here and why these levels are what they are. So, by the way, who else would do this for you guys and gals? Nobody, right? All right. So we have a. This was the gap, right, where the Trump rally took place from. This was the last reference high, the 219.60, and then this was the breakout, right, over 238. 228.34. Remember what I talked about here about the Fed day breakouts here, the 228.34 and this 228.59. So that area, that is the big breakout and has not been retested yet. And look where the 50 MA is coming up from. So if there were to be some type of a rollover here, first and foremost, we're in a channel. I've drawn in this channel. Artfully so, if I do say so myself. We have a progression line here that we got below, and now we're on the backside of. So there should be resistance here. This is also, if you recall, the bigger 1.618 Fibonacci extension, and this is of the entire rally from the 2007 peak to the 2009 crash low. So this is a really, really big, I think that's the, you know what, I don't want to cuff that. That's too big of a claim to cuff. So why don't we draw that in, and I'll show you how I do, this is sort of the I don't want to say the cheat to draw a Fibonacci extension, but how to do it in TOS. If you go from the high, and let me adjust it, it didn't snap properly, 157.52, and we go down to the low. Let's take out the in-between mumbo jumbo. We add in the 1.618. If you're also interested in 1.272s, you can add a curve, but for our point here, we don't need that. So no, I'm sorry. This was we already got there. That was 213.40, and look where this stopped here. I think that if we came up with the, look, that's where this high came to, where we had a correction. I believe this number that I came up with was this range here. Yes, that's the 1.618 Fibonacci extension of this consolidation range here. So, and we know in the past 1.618 Fibonacci extensions have been issues, right? Troublesome. I'll also postulate this for you when you're thinking about where would the rally be maybe looking to tire out and to stop. And if you take the range, the breakout range, which was the 157.52, and you subtract the 67.10, that's 90.42. And if you add that to 157.52, that comes to 247.94. So if you doubled the range of this and you just tacked it on up here, it's possible that we have more to go. As crazy as that sounds, I know that's going to be very frustrating for people who are short or who think that the market, can't keep going, but it is possible. 247.94 is a potential measured move of doubling the range target. That being said, if you took the 1.618 fib of this range and projected it up higher, and you get to the backside of this old progression line, we are at some potential resistance levels. If you, what is this number in here that I have? Text note. Let me move that over. I love when my text notes get covered up. This is probably a measured move. Yeah, if you 2x this range from down here, that would take you up to 236.69. So short term, we might be getting a little bit expensive. So what does that mean? So there's two things. One is that even though the market was closed on Monday, Sunday night had an overnight futures session, as will tonight. The market did go higher. So it's very rare, in my view, for the market to top out in an overnight session. The only exception that I can remember in modern times, and I've been trading for a while, as most of you know, is the Osama bin Laden peak. And that's really before the whole nonsense with the debt ceiling, I believe, came into play. And that was an overnight high that was good for a long time, and there was a quite substantial correction after that. That being said, this isn't that kind of a news. It's just, it is what it is. And this market, we're at all-time highs, and you can use technical analysis really until the cows come home. But when you're at new highs, there's nothing to the left, and that means there's no resistance. So this could keep going indefinitely. And I just gave you a new potential upside target of the doubling the range to potentially 247.94. So I'm gonna mark that into my chart after this video is done, and it's gonna be an interesting thing to watch. Short term, you had a stutter step here, and a day that the low here was 233.85. The low here was 233.93. So a bit of a higher low. If on Tuesday, for example, we don't go higher, and we take out these 2-day range lows, I think that is an okay right or right out short for, at the very least, a pullback to the backside of the channel. This may continue to go higher because this isn't much of a move to the backside of the channel, and potentially the 10-day MA. I do expect at some point a larger correction to retest this breakout area into the 228s, 229s, and the 50 MA, but I am not Merlin. I don't know exactly when that will take place. It's very possible we just continue grinding higher to the, to some of these other levels, or that, there's some kind of consolidation and then goes, or maybe there's a consolidation and then it breaks. We've had a lot of these breakouts that consolidate and then, either pull back or break out again. But as a right or right out trade, below these 2-day range, I like as a right or right out short, considering that's the 1.618 fib extension of the Trump rally range. And anything below there to me is vulnerable to a pullback, at least maybe to the 10-day, and maybe if we get, if you got in and got lucky, you get a retest of the breakout. But like I said, it seems unlikely to me that this is going to just completely fall apart, and we're going to get like some kind of a move down to the channel low without having bounces and stutter steps along the way. And that's why when I talked about doing the play, I liked doing the put spread overwrites. And now you can start seeing when I talk about levels. Remember I said the 134s, the 130s. I mean, sorry, the 234s, the 230s. Why? That's into this range. It's a retest of the breakout. And then the overwrites I did in the 211s, which are basically down in the almost the gap fill range. You could even do, if you want, in my view, look, the other breakout here was 219s and 217s, and that's also here a channel low and a big breakout area. So I think that and a 200 MA. So if you want to do put spreads, you can do, like just below here, maybe to the 50 MA, and then do an overwrite down near the channel low. I'd probably be looking to book half of it if it did come down to here, and then keep the rest of it on here, potentially with a stop. But keep in mind, we're coming from all-time highs. So if there's some kind of a pullback, you'd probably have a rally to at least a lower high before it came down, and that's why I like it in the much longer dated series. I don't think it's going to be, even here, look at this. You had the breakdown, you had all of this chop for so long until it finally got the channel low. You could have another scenario like this. I also want to postulate this to you, and I really am trying to spend a lot of time on this because it's very important. This has been a big rally, right? You've had a lot of funds that have underperformed and haven't participated. So we have a narrow window that we are coming into that we could have a pullback. But we have had a very strong first quarter so far. February's almost over. All you have is January, February, March. So if there is a pullback, I think the end of March would be window dressing, and you'd probably get a rally up to make up for weak performance. So I don't think the market is really going to fall apart until potentially the first quarter is over. Conversely, if there is some type of a blow-off move and this just goes full hockey stick, the end of the quarter could signal the beginning of a larger correction, because those funds would need to lock in those gains to have profits. So everyone at that point would still think that they're getting window dressing, and they'd really be getting lock-in. And that, I have seen in the past, has led to some pretty nasty summer corrections. So that's just what I'm thinking, and those are some of the levels, and that's frankly how I've been playing it. The expected move in SPY this week, and keep in mind with the low end of the VIX that we're in, I only really discount this to the move up. The moves down could be larger. Basically $2.17, 237.26 on the upside, 232.92 on the downside, but that also would have the potential for a move lower. One of the reasons also, and I don't want to get too sidetracked here, but I do want to talk about XLF. Look at this range here, this whole consolidation, and this is with the flash crash move. Look where we're up to. The 1.618 Fibonacci extension is a lot of technicals that are coming into play. So this is technically very bullish, right? You had a base here that consolidated in a breakout, but I'm a little cautious just because of where we've come from. The key here to me, this must hold over to 23.84 if it gets below there. And the 50 MA is also key. Look where it's held. So this to me is still a buy the dip as long as the 50 MA holds. If you lose the 50 MA, I think you'd see the lower end of range, and maybe even potentially at some point a retest of the breakout much lower. I don't know that that's going to be happening so easily, just because of the only way I see this happening is if the Fed really doesn't raise rates, and if something happens to challenge the Trump agenda of repealing Dodd-Frank and some of the other parts that go into that. I don't want to get too much into the technicals of that, but if the market started to not believe that there was going to be deregulation, that to me would be a cause for them to maybe look to sell, and that could be a problem. So that's the scoop with regard to that. All right, so that's XLF. While we're on XLF, let's just hit up a couple of quick financials, and then I'll bring us back into the major market indices. JP Morgan is again getting, I mean, look, this is just riding the lightning up. I think that stock is going to 100, 99, 100. But I don't know that I want to, I mean, technically this is a breakout. Anything over 88.17, I don't want to mince words, it's bullish. Anything over that is bullish. That was the earnings day. This was the earnings gap down. It's filled the gap and it's now above it. So anything as long as 88.17 holds. Back below there to me gets iffy. And again, it's the same situation with a channel and the 50 MA. So I think it's still a buy on pullbacks as long as the 50 MA holds for the eventual reality of it going to, I think, 100. It could just grind higher. If there's some larger market correction, this would be on the top of my list of stocks to buy near the channel low and near reference lows. They are the best in breed. Ameritrade is one that I had been bullish on, and I said we'd get 47s, and now I'm actually flipped, and I'm a little bit looking for a pullback. Not because I'm bearish. I love the company, I love the people there, but I am playing it with a put spread. This did come down. It hasn't followed through fully articulated, but I'm looking for a retest of these breakouts. And I did a cheap, a quick little put spread. But if they were to lose this low here, 40.93, I'd add to the position, and I'd be kind of just looking to take a few points out of it. I don't know that we're going to get a full move. That's also like you have a 50% fib below here. That's really where the breakout is. So somewhere in these mid 30s. Probably will catch it. I can't tell you that it's not going to fill this gap all the way down here. What caused this though, and I'm going to assume the trend line, by the way, and the breakout holds until, of course, it doesn't. But this has been down on Schwab cutting their fees, and I think that is going to hurt all of these companies' abilities to make the kind of money that they've made in the past. But that said, Ameritrade is the best. This is back, you had a W bottom, a W bottom, double bottom, and a move back to the high here in Capital One Financial. It came out that Amazon might be looking to buy them. Holy cow, right? This is back all the way to the pre-crash. JP Morgan's at an all-time high, and this is basically back. It got here, it pulled back, and now it looks like it wants to go. If you did a 1.618 Fibonacci extension of this entire range, you could get to 113.16 in Capital One. That would be pretty impressive. I also love that this consolidated and now it's kind of going. I think you could use Friday's range, or if you want to be a little bit, give it a little bit more room, 89.61. Anything below there to me would be iffy. Again, I like this on pullbacks really to the kind of the 50 MA or to the breakout. But this to me, this is all bullish patterns, very bullish patterns in these stocks. Let's go to IWM quickly. This here is a consolidation. You have a multi-day range here. If you start getting below this 137.61 or 137.20, then there's probably a quick short, basically the 10-day, maybe down to the 50, maybe if we're fortunate enough down to the range low. So this is basically a breakout of range, and it hasn't really gone, right? It should have gone. I think you could buy stop at over 139.84 for continuation, but you have this kind of like these reference lows. If you start losing these couple of day lows, you could try a short. So that's my thinking. But look, we're a long ways off from the channel high in this, and a long way off from like doubling up the range. So this area, if you kind of double this range, could project you up to 144s. IWM still looks okay. Looks a little hesitant. The expected move though this week is $1, just under $2, so 141.11 or 137.12 on the downside. Qs are just going, right? Holy cow. This is above the channel. If there's a pullback, when you break out of a channel, the first touch of the backside of a channel is always a long. And look, you have a trend line there that coincides with that. So if there was a pullback to the top of the channel there, I'd be a right or right out player. We're not at the 1.618 fib extension yet, which is 132.71. So it's possible the Nasdaq has a little ways to go. So my thinking there is the I don't know if I want to step in front of a short on this, but I don't necessarily know if I want to, chase it here. So I would be, like I said, an interested buyer on a pullback to the trend in the backside of the old up channel, or maybe looking for right or right out short somewhere near the 1.618 Fibonacci extension. The Nasdaq, though, is contingent upon a rather narrow group of stocks, right? The biggest of which being the famous Apple. Very impressive move. It's more than 2 times the range. It took out the recent high, and it's had a 3-day consolidation. So you basically are above the trend. So I'm thinking this. If it gets above this kind of doji bar, 136.27, it could continue up to some of the fib extensions, some of which are quite high. If this were to pull back, remember we're above the channel, I'd be looking for a quick right or right out short below 134.62, and maybe for a play to the backside of the old up channel, which would be basically retesting the breakout over the earnings gap high of day. So this 3-day range, above it, I think you can continue long. Below it, maybe right or right out short or a stop. Speed up a little bit considering we're have a heck of a lot more to go, and we're running a little low on time. Microsoft was basically a retail gap. It sold off. It's coming up. It looks like it's in danger of potentially some lower highs. If you were to lose this consolidation range of 63.98 or whatever, I really think the 50 though is the key. I mean, look here, it held so many times. So I think if you're long this, you probably can hang on as long as the 50 MA holds. If you start losing that though, and you lose this recent swing low of 62.75, then I'd be interested in maybe starting initiating a short, and for sure shorting rallies. Amazon is just a beast, right? I mean, this thing just holy cow, all-time high on Friday. I thought we'd have a pullback maybe here to the 50 MA. It didn't even. It just kind of stopped at the gap. It broke out, basically got close to the old all-time highs, basically came back to retest the breakout, and now going again. What is this starting to look like to me? Here you had this kind of a pattern. It might play out again, and there could be a move down, but I don't think so. I think this is going to go. This is looking to me like a cup and handle. You have the cup here and a little bit of a handle here, and anything above the reference old all-time high of 847.21 is bullish. It's a tough chase. I'd be down to buy pullbacks maybe to the 10-day and the 20 MA if you're want to do it that way. But I think Amazon is looking pretty bullish. Facebook just kind of fumbling around this 33.50. It's got a wedge pattern here, so this is either going to break hard higher or potentially hard lower. I'm starting to think it could be lower. We'll have to see. We're still inside this earnings bar day, so if you want, we've spent a lot of consolidation time here. I think you could buy stop at over 135.49 for a continued move higher, or if you want, maybe below 132.55 is that's this low too, 132.44, somewhere in that area. You have 1, 2, 3, 4, 5, 6, 7, 8 days of consolidation. I think if you lost that low, this would potentially come down, maybe even significantly lower. I'd be an interested buyer at somewhere near one of the fibs, like the 50% fib or the maybe even the 61.8, but I'd probably be looking to sell out of the money puts if that were to happen. So you could have this, you could sell stop it below 132.55, let's just say, play it for a triangle fill down lower, and then maybe sell some out of the money puts or reverse it. But if you're looking, I think at this point, after this many days of consolidation, I'd be waiting for it to break over that 135.5 really for a new money long. Twitter, this company, I'm not a big fan of the management there. I think they're pretty ridiculous. Finally, Jack Dorsey bought some of his stock down near the lows. You have reference lows here. I said over 16, which was the gap down high of day. It was a long, which I'm in. And I will use a sub 15.5 stop, because then I think we'd be looking at 13s. So that's the story. It's a long as it's above 16. Netflix, this thing is just kind of grinding its way higher. Still caught in the earnings day range, so you had a bit of a look above. Maybe it comes back down to the low. The gap fill and the 50 MA are really close. You have a trend line lower. If this does come down, I think you could sell out of the money puts as a play. If you want, you could also do put ratios, like buy some puts and then sell 2 times out of the money, maybe down closer to the 100 MA. I could easily also, if the market kind of has a rollover, see this coming down to the retest this sort of channel low. I can't say that that's going to be the case. I don't know what the news would be to cause that, but I really, once you're still confined inside of an earnings gap bar, I don't like to play it until it breaks. So you really need to see it definitively above this 143.46 or definitively below this 138.25, and I would play it accordingly. The 50 MA here was key support. That's where it broke out from. It has not had a 50 MA touch since, so I would assume the first go round probably you could sell some near dated out of the money puts or try it right or right out long with the shares. Google is starting to look a heck of a lot better. It filled the gap. You're getting close to the backside. You are basically at the backside of the old uptrend here. So I think you could kind of probably buy this on maybe on some dips, at least some out of the money put sales. I think that that's going to be choppy for a while, but there's definitely some premium to play with that. NVIDIA is basically in a big range. It got to the top end of the range. It couldn't break out, so it looks like it may want to come down to the lower end of the range. The key here is the 50 MA. You've had 2 look below and fails. So I think you could use Friday's low as a stop if you're long, or as an initiation for short for a move lower. Or if you want to say that this now is a successful hold of the 50 MA, you could buy stop it over Friday's high of 107.41, and then you'd look to add over this 4-day consolidation over 110.15 for a move back higher. The 10-day is sloping down. That might be some resistance here. It was here once it came down, so we'll see. That would be my first target if I were playing, for like I said, if assuming it is an up move, the 10-day would be my first target for a bit of a day trade. So yeah, that's my take. If you're aggressive, long above Friday's high. If you're looking to add above the 214 day high, that's Tuesday. This was Friday, Thursday, Wednesday, Tuesday. Yeah, above Tuesday's high. Below this low, though, I think this could continue down, and maybe even this was the original consolidation funnel, right? Here down into the 986s. I think that guy from left, right, from Citron is targeting somewhere down there, 90ish. So maybe it gets it. 50 MA here is the must hold, though, in my opinion. Tesla did what we discussed. I did a lot of detailed review in this in the last week's video. Let's go into 4-year daily. That this has had these big runs. This last one was $128.29, and this one now is topped out at 107. I think that this could see 306 if you took that measured move and you'd clear the old all-time high. This could get up. I mean, we'll see where the channel high is. The key here to me is the 265 level. That has been big resistance for a while. It broke out, it held, and it re-held. It basically came back and retested. So as long as 265 holds, the bias is long. If it were to lose that on like the earnings gap, I think that this might want to retest the 200 MA, which was very key to break out of, somewhere between the 50 and the 200. So as long as 265 holds, I'm cool with long. You can see that's also the trend line, and basically the 20 MA is just a bit below. But below there, it could fall back quite a bit. Expedia. Alrighty. So this reported it was a bit of a gap and crap. We're back down by the 50. 50 MA is the must hold. This was also a reference swing high, really basically a breakout level. If it were to fail, I think we could see the gap fill. If it holds and you clear this like last recent high, then this could go up to the channel high. But looks really kind of iffy in my view. Price line, when you talk Expedia, it's hard not to talk price line. This thing is just a total monster, right? Broke out. I have a feeling this is going to be a Costanza. Do the opposite. You have a few days till earnings. So if it pulls back aggressively, it might be a long. If it continues rallying, it might be a short, but could also be a kind of a gap and crap. Like if this were to gap up to the channel high at the 1.618 and channel high, then it could set up for a short. Like a lot of people won't be looking at this and won't realize it. They'll think it's a big, potentially professional gap, and it'll really be a retail gap, and you could short the bejesus out of it at the channel high. So that's the kind of the plays I'm looking, and we'll get into that as we get a little closer. Restoration Hardware, not PH, although this is something else, this Parker Hannifin. Restoration Hardware. This is a one I kind of bought in above these highs, and then it went up, and then it had this downgrade, which was crazy. It was Buckingham downgrade. They basically put a price target that was still $20 ahead of the stock. Once it cleared there, I added. We had a gap up, which looked hell of a nice move, but it's been selling off. The key here to me was the 20 MA. Look, this is where this is stalled a few times. As long as this kind of holds the 20, maybe even the 10, this is basically where I did the add. I'll probably try to stick with it long. We'll see how that plays out. I'm a little disappointed that we're below this low, and anything really below 27 is a little iffy and vulnerable. I had good trade location on that, and I was really looking to play for more than just a buck or two. So if I get stopped out, I get stopped out. It is what it is. But I am looking for this to maybe rally a little bit more. Under Armour, another dumpster dive play. This is at the secondary trend line. The primary is significantly lower, but you're basically at a 61.8% fib, a channel low that I've drawn in, and the primary trend. Would be tough for me not to at least give this thing a try, and I have, and it's just been consolidating. We're going to have to see if this breaks into the gap. I like that it's consolidated a lot here, so it might not just be like a poke into the gap that fails, but as long as you're above the 10-day, I'm cool. Look, this is where it broke down from. So as long as it holds the 10-day, I'm all right with it as a right or right out long. By the way, if you start losing these reference lows down here, like 20, just get the F out, because it could go a lot lower. Alrighty, MGM. This is one of the play it again Sam requests. You have a consolidation range here. 2 times this range to the low is 25.10, and the 200 MA is roughly here. So you broke a secondary trend. You've fibs a heck of a lot lower. I'd probably be interested in this really close to the 21 area. If this were to really kind of collapse, I'd sell out of the money puts, maybe like 19s. But you could use Friday's range as a key above the high, I guess, is a long for a move up, probably to retest the low end of the range, the 27s, 86s. Below the low, this could continue a bit lower. The 200 MA, though, look where it was, all the support. Here it broke, but here it became resistance. Again, it became the support. So the 200 MA is the must hold to my eye. Chipotle, this looks like it's trying to, I don't know, form a bit of a rounded bottom, higher lows, some higher highs. It looks like it's a bit of a repair to me. As long as you're above 419.30 or really the 200 MA, I'm cool long. Below there, it's just back into the slop, and I wouldn't be that interested in anything there. Hertz was trying to look better. This is one that I'm not so thrilled at. I tried playing this long above here, and then Avis had this bad report, and now it's back below, so this might be a stop out, unfortunately. If this were to lose, you'd probably go down to the 17, retest the 1720. I know Carl Icahn and company are in these, and they have earnings coming up, so if this really does barrel down lower, it may set up for a right or right out long. We'll have to see how that plays out. The aforementioned car, this thing is just a debacle, right? I have no position in this. I don't think I've ever traded this stock, actually. Top of the range failed. Probably going to see the lower end of the range, the 30s or the 28s. It seems like that is where this is going. Anything below the 200 to me is rather vulnerable. Back above, maybe it starts repairing, but does look a little bit weak to my eye. T-Mobile, rather impressive move on Friday. I think that's what all that SoftBank investment has been in, to kind of butter up the administration to allow the deal to go through with Sprint. So I didn't think that deal would be allowed to go through. I am starting to think it might be. If there's a pullback to the backside of the old, this is also, look, this breakout bar, I'd be an interested buyer on the backside of the old channel for right or right out. So above Friday's high, I think long. Below Friday's low and a 50 MA, it probably could be a short for a pullback to the old channel. Verizon, I think everyone's like, oh, why is Verizon rallying on this? This is a head and shoulders topping pattern, and you had a neckline break, and now it's a little bit above it. You're still below trend, but a T-Mobile merger with Sprint actually would be good for Verizon, because that would mean that they probably would stop cutting prices. So maybe the margins in Verizon start to firm. They've now started giving more for, I've said this for a while, people were all hopped up chasing the stock for a dividend, and I said that this thing was going to be a problem because they're going to have to start giving more for less money, and that has played out exactly. So if this were to fill the gap, I think it would be a gift for a short. But anything below these lows, these reference lows now, double bottom, I think you'd get some articulation down to fill up the gaps maybe in this to reference lows. I'd be interested in buying maybe some down there, but down at like some fibs. But up here, this to me looks a little iffy. I think you could use Friday's range as a gauge. If you were to lose Friday's low, I think you probably do get a move lower. Above, I guess, if you want to stick with it, maybe it does get the full gap fill. We'll see. Kraft Heinz. I don't like getting involved in these types of stocks. This was a move down, and then there was some rumors that, actually news that they were looking to buy Unilever. Now they're not. So I would assume that this will go lower again. If they're not buying Unilever, why would this move be up? So it probably should fill up the gap and maybe go even still lower. Anyway, that's my story. I'm sticking to it. Have a great trading week. If you like my video, hit the thumbs up, and please favorite and retweet on Twitter. Cheers.